Risk management in Forex, how to calculate your position size. This is what we're going to talk about in this video because risk management is one of the essential topics in trading. Without a proper risk management, the best strategy in the world can't succeed long term. So therefore, it's really essential to be able to calculate the correct amount of units to buy or sell for a currency pair. This video will help you to do so and definitely improve your trading effectively, because if you can calculate your risk, it's the first step you need in order to be able to manage your positions in order to be successful in trading. So let's start right away and take a closer look at the chart. Here we are at the New Zealand dollar, US dollar. That means New Zealand dollar is our base currency and the US dollar is the currency that is voted with this. So what does it mean for 1 New Zealand dollar? We get at the moment exactly 0.60627 US dollars. That's what 1 New Zealand dollar is worth at the moment. But what is this telling us for our position sizing? So let's take a look at the digits here. What we see here is 6 digits at the whole. So 1 before and 5 after the decimal point in this case. In order to calculate our position size, we need to know what a pip is. So the second number from behind, so in this case here, the 2 is our pip size. So let's make an example. We have our entry point at 0.62463. The 3 I will leave out because I will calculate in whole pips. So we have 6246 minus 6194, which equals a pip size of 52 pips. This is what we are risking with this trade. This is step number 2, but what are we going to do with these pips now? And here I have a table how many pips are which value. There are 3 main sizes that we can trade. That's the standard, the mini and the micro. The standard is worth 100,000 units and is meaning 1 lot. Lot is of course that size that we can trade, and with 1 lot we will move $10 per pip. So in this case we have 52 pips that we're risking, so 52 times 10 means $520 that we're risking in this trade. But for those who have smaller accounts or want to risk less, there are more options. One is the mini, which is moving 10,000 lots and is 0.1 lot worth. This means we're moving $1 per pip, so in this case the risk would be $52. But there's of course one more option to go even lower in risk, and this is the micro, which is moving 1,000 units and is worth 0.01 lot. So we're moving $0.1 per pip. So in this case, it would be $5.2 that we are risking. So it's not really hard to calculate the risk, but it's really essential. Once you know how it is working, it is really easy. But there is a specialty that you just need to know. Here we have the 4th digit after the decimal point, which is the pip size, but there is the Euro Japanese yen, for example. And of course here we have the 2nd digit from behind, which is our pip again. But here you see it's already the 2nd number after the decimal point. This can be confusing really fast, but you just need to be aware of this fact, and that way you are prepared to calculate it easy. We will do a quick example for you to get used to it. So here let's say we enter the market after the pullback is ending into the trending direction long and place our stop loss here below the last low. And then we see we have a risk of 15885 minus 15710, which equals a pip size of 175 pips. So this means for us, if we are trading 1 lot, this means 175 times $10, which is a risk of $1,750 for 1 lot. So 1 mini lot would be 175 times $1. Easy calculation. This would be $175. And for a micro lot, this would be 175 times $0.1, which equals $17.5 of risk. There are really different options, different sizes, so each trader needs to find out which size is the best for him or the right one for him or her to trade with. So I would recommend in general. Of course, it always depends on your trading strategy, on your trading account size, on your experience, of course, and of course on your current state of mind, and also the market phase. So is the market phase really good and you're making good winner trades? Of course, this is a situation where you could raise your position sizes. And when the market phase is going worse, so that's the situation where you could decrease your position size. But of course, this always needs to fit to your strategy. It has to be written down in exact rules to follow, so it's not random but repeatable, of course. Since with a good strategy, we want to repeat our profits for a good and long-running system. So for experienced traders, it's not unusual to risk 5% per trade. But especially for beginners, I would recommend a lower size of risk, so up to 2%. This is possible for beginners. Higher I wouldn't go in the beginning. So now you know exactly how to calculate your position size for your next trades, but don't forget to write it down in your trading strategy how much you want to risk. If you're risking a certain percentage or a certain pip value, this is of course up to your strategy. So go ahead, try it out yourself. I will see you again next week with the next video. And if you don't want to wait until then, you'll find below this video the link to my website. See you there. Bye bye.